Hi, my name is Simon Marcotte. I am the President and CEO of Northern Superior Resources, which is focused on two provinces, Ontario, and especially in the province of Quebec, where we have been consolidating the rapidly emerging Chibougamou Gold Camp. And I also recently made the headlines where I published an article explaining why I strongly believe gold is on the verge of becoming the next financial tsunami, and that gold will reach $30,000 in the years ahead, just like oil did in the early 2000s.
Relatively. Right. You're right. There's a few things happening there. You're making the headlines. Also saw your video of deep dive. That was kind of a good way of kind of explaining what you're trying to do there. Do you want to maybe sum that up for us?
If any one of your audience wants to watch the video, so first there's an article you can find. Just Googling my name and gold 30,000. There's a written article that goes through the thesis. Within the article, there's also an embedded video that is a very long and boring video that you can find on YouTube. It's like reading a book, but it goes through the thesis as well. But if you want a quick version and a more entertaining one, you can Google deep dive and Simon Marcotte Gold 30,000, and you're going to find it right away. This was just published a few days ago and already, getting some very respectable views. So what I'm saying there is simple. Gold is the next tsunami to come across. The gold stocks have yet to perform, and that's because gold shouldn't be where it is. Gold should be down right now. If you look at the way the real rates have been behaving, yet gold has been doing excessively well because the central banks globally have been buying gold ahead of what we are going to see. So when the real rates do turn negative, or at least go down, then I believe we'll reach negative territory. Then the value of the gold equities will start reacting and play catch up. So I think the senior have a lot more room to go, and the junior will catapult to levels that we have a hard time to imagine right now. And in order to define this upside, oil did the same type of reaction, went up 10-fold, 11-fold between 1999 and 2008. So that would take gold to the levels I'm talking about. But also, there's other ways to fundamentally justify such a move. You have Tavi Costa that published a great chart, and the way I read that chart is simple. Is the last time you had a period of negative real rates, gold did react extremely well. And the way to look at it is the gold reserves of the United States are kind of the book value of the debt of the currency of the United States. So when you value a share price, if everything goes well, you will. The market will discount the future or the present value of the future earnings or profitability of the company. But you know very well that when things don't go well, and things go sideways, or we have a company in free fall, or the stock is in free fall, then the market turns its attention to the book value of the company, of the liquidation value of the company, and that's where the market will establish a floor price. Well, same thing is true for a currency. And the gold reserves of the United States is that book value. So if you go back to the levels we've seen in the 70s, equivalent to today's debt level, then gold would go to 24,000. But I would point out that at the time, the strength of the U.S. institutions and the rule of law were never shaken. And that's a question mark right now. So only the future will tell. So I think, gold will do what oil did in the early 2000s. But since 2008, there's been a lot more liquidity injected into the system, and it seems to me that everything becomes a financial tsunami now. And I think that gold could react in such a way, faster than it took for oil to go from $12 to $140. So, so I invite people to look at these things, because I also dive into that macro perspective into why I believe we're going to see real rates go down and real rates go negative. And I go through, obviously, that's the easy part. We are in an inflationary environment. the policies of the Trump administration are inflationary. If we don't see inflation, it'll be because the economy is going to be very weak. But more importantly, in order to see an impact on the yield, I dive into clues that we see in both Project 2025, the famous Project 2025, Chapter 24, and I also dive into the paper from Stephen Marin. Stephen Marin, who published a paper immediately after the election of President Trump, and he has since become the chair of President Trump's economic councils. And so far, everything is being implemented. It looks very chaotic. It looks like it's being improvised, but it follows that blueprint to the letter. And I go through all of that and what to expect next in those macro perspectives. So I invite you, Matt, and everybody that's watching to search for these articles and videos.
For sure. Well, yeah, it kind of interests me. So like with something like Project 25, which is obviously quite controversial, what's the... obviously relating to bank reserve policy, what's the chance of it getting implemented without any kind of sort of political or institutional barriers?
Well, for 2025 as a whole, yeah, I mean, during the election, President Trump or candidate Trump at the time was denying any knowledge or involvement of Project 2025. But in the first week in office, about or near 70% of the executive orders that were signed were recommendations from Project 2025. So it is hard to believe it doesn't have an influence.
Right. Okay.
So it has all to do with bank reserves. I believe that when Mr. Trump or President Trump is talking about the new golden age in America, I think that's what he has in mind, to release the $3 trillion of bank reserves that are locked in right now at the Fed, because the Fed is paying interest on those reserves. And that's a law that they passed back in 2008 when they printed all that money so that everybody would calm down and people would understand the banks were not going into bankruptcy, so that this credit crunch would stop imploding. They printed that money, but they didn't want that money to enter the system. So most of that money stayed parked at the Fed in the banks' checking accounts that they have at the Fed, and the Fed is paying interest on that. So that the banks, if they're getting paid interest without any risk, they're not going to turn around and lend out that money at a lower yield and take a credit risk on top of it. They're going to keep the money there. But if Project 2025's recommendation would be to be implemented, then that money, the Fed would stop paying interest, and then that money would enter the real market. So either it would create inflation, or either it would put pressure on the yields, or a combination of the two, depending how the economy is doing. Really, that will be up to the banks, but for sure it'll have a massive impact, and it'll bring down the real rates. I'm not saying that that is the only thing that I'm looking at. There's just one thing that could be a major, that could be a game changer. But the paper from Stephen Marin also dives into what to do. Right? He's basically said, start by putting very high tariffs, and then negotiate those tariffs to come back down in exchange for policies taken by foreign countries to strengthen their own currencies and weaken the U.S. dollar. So I can guarantee you this is those type of conversations that are currently happening, it is the equivalent of the Plaza Accord of the mid '90s that they're trying to re-implement differently. Those countries would not sign again. Japan would not sign again the Plaza Accord of 1985. They wouldn't, and so they need, the U.S. need to take a different approach. So President Trump's policy seems to be hectic, improvised, but that's his style. The reality is, agree with it or not, those policies are well planned and designed. So there's a lot to look for. But the bottom line of all of this is this administration is looking to implement wartime financial conditions in order to remanufacture the United States. And it is, it is a big gamble. Would it work? We're going to be front row, but it doesn't matter if it's going to work or not. The real rates are coming down, and gold is going to react in a massive way in the years ahead.
Okay, so, like I say, so with Mirren talking about currency devaluation proposals, I mean, chances of legal challenges are high, I suspect.
From the own U.S. government?
Yeah.
We'll see, but what I can tell you from the outside is Mr. Trump seems to get what he wants. And the proposals that are being suggested are absolute draconian tools to weaken the U.S. dollar. I mean, they're really, without saying it, it's basically a default on the U.S. debt that they're suggesting doing. I mean, they are suggesting, for example, to implement a user fee on the bonds on the foreign countries that own the U.S. Treasury bonds, i.e., if you're the government of Japan, you own a U.S. bond that pays you 5% a year. Well, we're going to start paying you only 4% a year and keep 1% as a user fee. So obviously, the market would react to these things, and it would have a clear impact on weakening the U.S. dollar. So there's a lot to dive into this, but I am absolutely convinced that the real rates are going down, and when that happens, the equity market will have to play a huge catch-up, right? Because the gold stocks are not following the gold price right now. And interestingly enough, that's kind of what was happening in the late 90s. Because if you look at the oil price throughout the 90s, it was going from, 10, 12, 10, and every time it would go like around 12, the economy would slow down and the barrel would go back to 10. And the idea back then was, the world cannot function with oil above $10 a barrel. So in 1998, 1999, the oil stock had never been this cheap on a price to cash flow basis, NAV basis, because the market just thought $12 was once again not sustainable. So they expected the oil to go back down. That's why those stocks were so cheap. The market was wrong. The oil kept going and went ultimately to $140. And at some point, the equities started to play catch up to that oil price. And at some point, the whole world decided that we were running out of oil. And at some point, short period, but some equity were pricing a premium to the oil price. And remember, we saw crazy things like Barrick Gold buying an oil company as a hedge for their electricity costs, right? So we always overshoot on both sides. But the value in the junior space right now is mind-boggling. Like on the eve of something that massive, that structural, it's a structural change that we're seeing, and I think we're going to do so well. But if you look at the way the juniors are pricing in or being priced as per their resource in the ground, as a percentage of the spot, like we've never been this low. It's unbelievable. So, we're going to get a big readjustment of that value in the years ahead. Does it start next week, next month, next year? I don't know exactly, but it's coming.
Okay, so I think you're looking basically gold rises when real rates. So that's interest rates minus inflation.
Correct.
Turn negative, right? What happens in a period of like stagflation, or when both rates and inflation are high? How does that impact gold?
Well, stagflation is when economy is weak and inflation is high. So if economy is weak, your rates can't be as high as they would normally be, right? And stagflation is exactly when you get to have negative real rates. Now, so if you like, when the real rates are positive, it doesn't really make sense to own gold. Warren Buffett is right on this. It doesn't really make sense. Gold doesn't pay you anything, doesn't pay you a dividend, doesn't pay you an interest, and you need to pay to store it somewhere. So it doesn't fundamentally make sense. You just going to own a bond that's going to pay you interest, which is more than what you lose with the erosion of inflation, right? So it makes sense so the whole world has its money into the bond market. But when you have real rates that are negative, then to own bonds destroys value. The interest that you receive are less than what you're losing with the inflation. Conversely, it's gold that becomes a vehicle where you can create value passively, right? Because gold always keeps up with inflation, and if the real rates are negative, you can even borrow at a rate that is below inflation. So you're going to borrow, and then you can buy gold, so you can actually make money passively like that. So if you have just a tiny bit of asset reallocation from bonds to gold, it can be extremely impactful, and that's why you can have very explosive situations, just like you had in the 70s. Now, gold does not only perform when real rates go negative, obviously. Gold can also perform when real rates go down, because gold becomes cheaper, right? But it is, you can get excited when you get close to the 1 yard line. But when you do score, when you do cross to negative real rates, it does have a massive impact. So you saw extended periods of negative real rates in the 70s, and precious metals went crazy. You saw that during World War II. But you also saw that much more recently than that, but for a very short period, right? At the beginning of COVID, the real rates went down for just a few months, and the gold stocks catapulted at the beginning of COVID, if you remember, right? So the market hasn't forgotten about those stocks at all, and I also find interesting, if you look at the TSX Venture Exchange, if you look at that index, it is breaking out. That's something that's very, very, very encouraging. That's breaking out, and it's going through an air pocket. That tells me that we could be pretty close to that catch-up rally that I expect.
Right. Would you say, we should definitely talk about your press release today, by the way, but before we do,
Yes.
this is kind of interesting, and it kind of undermines the thesis of why people should invest in gold. So I want to challenge you on a few things. So would you say that, obviously, I think Bitcoin buyers have traditionally been anti-fiat. Gold, do you think, would you sort of categorize gold investors in that same category?
I think it's different. Listen, the crypto sector is something, right? But most of the time, crypto will trade with kind of the NASDAQ. It seems to be the same type of investors. So if the NASDAQ crumble, I'm not saying it will, but if it does, I would expect some kind of a pullback where gold will kind of be the new place to be for those investors. But crypto is not going away either. The Trump administration is very close to this world. They are making money personally on the crypto world. So I don't know what's going to happen with crypto, but it is not going away. Now, will Bitcoin go from 100,000 to 1 million? God, maybe. But what I do know is that nobody's been looking at gold for a very, very long time. So we're starting from a very cheap base. And even the gold stocks have, especially the juniors, have yet to move at all, right? So I think you're going to get much more torque from this point on into gold and gold stocks that you will into crypto. So there's money to be made in crypto. I'm not a specialist, but to me, gold's been a lot cheaper. It's been forgotten for a while, so there's a lot of torque there.
So why did gold take so long to react? Because if I look at the kind of COVID period, so as an ex-banker, I think I used to know how the markets behaved and how I needed to react, and therefore what I needed to do, and timing it reasonably well. Give or take. During COVID, I found myself saying this phrase over and over, which was like, the markets are not behaving normally. You'd expect in a moment like that, with COVID and printing of money and wars and all sorts of distress on the system, that gold should have come into its own in the sense of safe haven and all of that, all those sorts of wonderful cliches and stuff. It didn't. Did that surprise you during that period as well?
No, I mean, gold did react well at first. Gold stocks did react well at first. I mean, Northern Superior went to $1.50 at the beginning of COVID. That was a heck of a rally. And financings were getting done. It just didn't last very long because the Fed, as soon as we got out of COVID, the Fed started to raise rates very aggressively. So gold stocks performed, gold and gold itself performed very well until the announcement that they had come up with a vaccine. At that point, the market started to price in the economy reopening. And at that point, the market started to price the Fed increasing rates in order to calm down inflation. So even though we had a long period of inflation that followed COVID, the Fed got ahead of the curve back then, and they increased rates faster than inflation. So which means that the real rates were not going the way we wanted them to go at all, right? So that's why gold did not perform. And a lot of people kind of miss that. There's like, well, there's tons of inflation and gold stocks are performing horribly. So that's it. I'm out. Right? So you have to look at the real rates. That's where it makes sense.
But there's two things going on there. There's the early stage sentiment and optimism in the markets. Then and in terms of equities, there's a few things that are happening. There was a lot of money floating around in the junior space in 2020 as well. Products too much money, and any old thing was getting financed. Then you've kind of got a scenario where when things didn't start moving, as far as people got a little bit nervous, rates were going up, disposable income for retail was not there. Discretionary spend, therefore, was not there, and the juniors started getting hit really hard in terms of the ability to raise cash, the cost of that cash, etc. And then there's the kind of where we go with a lot of these conversations. I'm sort of always get a bit uncomfortable in terms of what the banks and what Wall Street was doing in terms of and central banks were doing in terms of controlling the price of gold, not just equity. So. Did you sort of see there was a lot of confusion with all of those players in the space holding that back, or do you blame it full and squarely on the Fed?
No, it is a market-based reaction. I'm sometimes being asked, if we could have a reset where the government steps in and sets the price of gold. No. The gold is going to go up by itself. The central banks are not going to stop buying gold. The Asian investors did very well buying gold in recent years. And when interest rates do turn negative, the European investors and American investors, which is really where the money is, are going to jump on the bandwagon. And I think the price of gold will accelerate to the type of levels that I'm talking about. So it's market driven, and frankly, I think that the U.S. government right now, unlike what we've seen in most recent history, I think that they seem to want the price of gold to go up. I mean, I wouldn't have seen any, we didn't have Twitter back then, but the U.S. was always about try to find a way to control the gold price. That was kind of the theory of the Gibson's paradox, which is just a theory. But the U.S. was always seen as wanting to control the gold price. Now it seems to be the opposite. You have President Trump, who, remember that famous tweet recently that said, who owns the gold makes the rules. There's got to be something behind that, right? And it seems to align with the type of things that we read into Stephen Maren's paper, which to me is that they want to force the market into negative real rates to bring back manufacturing in the U.S., which, by the way, I think has merit. I'm not the guy who's going to say that to remanufacture the United States doesn't make sense, that we're going to get people to sew jeans for $3 a day. I don't think this is what we would be looking at. I think what we're looking at is a combination of AI and robotics that could be ignited. These technologies seem ready to change the world, and to remanufacture the U.S. could be what these technology need to really bring us into the next era. That I don't know what it would look like. So I think it has merit, but it is a very risky proposal because if you're going to do that, the United States government is always behind the biggest innovations we've seen, right? The R&D is done either by NASA or DARPA, and then the United States government doesn't keep patents. Then companies commercialize those discoveries. That's been the story of Apple and Tesla and all that. So all these kind of big evolution that we've seen were driven by the United States government. But any moonshot, like when Kennedy said let's go to the moon, people were behind him. Now, I mean, you listen to the CEO of most major companies, they don't seem to want to get on board with the plan of remanufacturing the U.S. They're all asking for exemptions, which to me makes this moonshot pretty risky, right? But again, doesn't matter. What I care about to care about gold and to be positive for gold is the tools that they are looking to implement in order to force this remanufacturing.
But there's going to be, like with all metals, when the price goes up, we saw it with lithium most recently, when prices go that high, most projects are economic. Crummy, shitty projects today will be able to make money, and there's going to be I guess a gold supply response. I mean, but obviously, scarcity is a good thing, but overproduction not so good.
Mines are not going to be able to meet the increased demand from the entire financial market. A mine takes a long time to get to be put into production. So, I mean, you can mine bitcoins too, and bitcoins.
But are you suggesting that
$100,000?
Yeah, but are you suggesting you're not going to see a sustained price increase? Is this a
no? I think you will see a sustained price increase.
Okay.
I mean, gold is not a commodity. Gold is a financial instrument.
Mm-hmm.
Gold doesn't trade on supply and demand or physical. It doesn't, because the picture, supply and demand picture can change on a dime, right? So let's say that you have negative rates for a while and gold goes crazy, and then if you have a change in administration and everything is reversed, well, the central bank are going to be selling gold pretty fast. So it doesn't. Historically and today and in the years ahead, I don't see gold being valued on a supply and demand the same way iron ore can be or coal can be.
And you think that's fine? You think that's fine? You think that's a good thing? We're not. It's irrelevant how much physical is produced, and we're trading on gold.
The output from new projects is going to be a tiny fraction versus the capital that will look to inflow into that space.
Should we talk about today's press release?
So if we turn to Northern Superior, right?
Yeah.
So, but I like to put things, because we did have a very good press release where we're talking about a new discovery, and as you know, it's not that easy to get geologists to use the term new discovery. So that's in our press release. I want to go through all this, but I thought I'd take a minute to in order to kind of position the Chibougamou Gold Camp and Northern Superior
should
on the
do
global
that.
map here, because I really think that the Chibougamou Gold Camp is about to get the spotlight put on. And to give you an idea of the size of everything, right? I mean, even in the recent, more difficult years that we've seen, you've seen companies perform well in Guyana, in Yukon, and in Finland, right? So, Yukon was the biggest camp. That's even two camps, right? You have Central Yukon and Western Yukon. But, companies like Western, White Gold did well even when the market was extremely difficult. And then Guyana was doing well as well, right? that's not, Aris is in Colombia, but they're also involved in Guyana. A company like G2 did very well in Guyana. So when you have a camp that emerges, it's good for all of the companies involved. Guyana is now at about, I think, around 22 million ounces. And you also had Finland, right, that attracted a lot of capital as well. So the camp of Finland is being driven by Agnico Eagle. But you had companies like Rupert and Orion that did very well because this camp was emerging. And in Finland, you have something like 12 million ounces in total. Well, the Shibugamu Gold Camp is really not that far behind. So the Shibugamu Gold Camp is now between IAMGold and Northern Superior. There has been a total of 12.4 million ounces that have been defined so far of resources in different categories. But there's one specific attribute of this camp that I'd like to remind you of, which is all these assets in the Shibugamu Gold Camp are very, very close to one another. And we always thought that all of these assets could feed the same mill. So the more you consolidate them, the more you make these assets viable, and therefore you increase the value of these ounces. So that's what we've been doing. Because if you go back a bit less than 3 years ago, all of these assets that define this, that are behind these 12.4 million ounces that I'm talking about, they were owned by 5 different companies. And we took a leadership role, and we made a few key acquisitions, and now we went down to 2 companies, and that's IAMGold and us. So we've been quite active with the drill bit. But one thing before I get there is that one of the reasons why I think this camp is about to really being put on the map is a consequence of the spectacular success that IAMGold has been having in the last couple of years at Côte Lake in Ontario, right? So IAMGold, if you go back several years now, they went through a tough time, a bit of a roller coaster. When they were building Côte Lake, they had some balance sheet issues and they had to sell international assets, and they were able to do spectacular deals, if you ask me, at a time where nothing was transacting M&A wise, and they were able to save the balance sheet and protect the share count, and finally they really got Côte Lake to perform. Coincidentally, with the appointment of Renaud Adams as the CEO of IAMGold, I want to give him all the credit, but the coincidence is pretty clear that since he's been there, the company now can't seem to be doing anything wrong. Now, they have remained laser focused on that ramp up of the production at Côte Lake. But I was listening to their conference call just a few days ago, and they're saying that by the end of the year they should be on cruise control at Côte Lake. So once they have completely de-risked the operation at Côte Lake, then to keep talking about de-risking that operation is not going to create shareholder value anymore. I would expect them to switch their focus and a large part of their narrative towards their next stage of development, which is the Shibugamu Gold Camp. And to that effect, on that conference call, the CEO of IAMGold, or the management, he was not the only one talking about it, but they did mention a few things about the camp, which we've been saying all along, which is obviously they were talking about their main asset in the area, which is Nelligan, but they said it's not only one resource. They said in the conference call, if you look at the maps or the sketches, it's really a trend. It's really a camp, and it's not limited to one resource. So he said they think big when it comes to Nelligan and Shibugamu, and they mentioned that they see upside in other areas of the camp. So he mentioned that he sees the camp or their assets in the camp to go at 15 plus million ounces. And we completely agree with that vision. It's really an emerging camp, and I think in the months ahead, it's a camp that's going to become there's going to be put under the spotlight globally. And I think that
Mm-hmm.
Northern Superior is sure to benefit from that.
Okay, well, let's talk about. You're right. That is worth talking about, because the scale of the opportunity. You kind of set up the gold thesis, but the scale of the opportunity at Shibugamu is important to understand as well. And let's get into the press release that you put out, because this will maybe help people understand your role in that, not just as a consolidator, but in terms of what you've got. So why don't you talk through maybe some of the numbers that came out of that, and obviously say the D word is important, discovery. It should not be used lightly. So what have you got?
Yeah, so maybe just to remind you before I get into the most recent press release, we feels pretty strongly that we may own the key to the camp, or if the main asset of the camp undeniably is Nelligan right now. This is IAMGold's asset. They published a new resource on it, a total of 8.3 million ounces total of resource at the moment, and growing, and is growing very quickly. Clearly IAMGold is very excited about this, and they should be. But it is the same type of asset that they've built in Ontario, which is a bulk tonnage operation. And to me, when I look at these projects, the payback period is absolutely paramount. And in order to have a lower payback, which will allow you to really attract the capital to build something like this, if you want to lower the payback, then the profitability of the first few years of production are very, very meaningful. And if I look at Filibert that we have, which is only 9 kilometers from Nelligan, and to put things in perspective, so if you put a mill between those two, that's 4 or 5 kilometers of trucking distance. Well, those pits in that area are about that, 3 to 4 kilometers wide. So put things into perspective. But if you look at Filibert, we have a very good metallurgy, right? So with a strong metallurgy, you can recoup more gold per ton that you mine and process. So if you start with this higher value material, you're going to lower your payback. And our grade is important, just as important. So Nelligan has a resource of 0.95, and Filibert has a resource of 1.1 gram a ton using the same cutoff. So that's 15, 18% more gold per ton that you mine and process. But all of this can be optimized. And if you look into the sensitivity of our resource of Filibert, you will see that if you move up the cutoff grade just a tiny bit, from 0.35 to 0.5, you'll see that we lose only about 10% of the ounces, which speaks to the quality of the ounces. But then our grade becomes 40% higher than Nelligan. So, again, there's a little of optimization that needs to be done to prove all of this. But to me, I think the camp right now, already has about 12.4 million ounces defined by the two of us, as I mentioned, and it's going to grow. But what the best way to create a lot of value from here is to optimize this camp. I think there's so much money to be made here that the mining industry is going to find a way to put into the right structure. So who knows how that would end up. There was an analyst asking the CEO of IAMGold yesterday on the call if they would bring a joint venture partner for the camp, because that's probably from what the analyst at National Bank wrote into a note recently, that IAMGold to bring a joint venture for the camp. So Mr. Adam mentioned that no, not for now, because he does not want to share the upside of building the ounces, which makes complete sense. I mean, IAMGold can take this project from here and build a lot more ounces and create a lot more value by themselves. That's not an issue. So why share that? But I don't think that we should rule out the idea of them bringing in a joint venture partner for when it's time to design a mining operation and obviously then build something. So time will tell. That was triggered from a comment written by the analyst at National Bank. So, which brings me to today's press release, or I should say yesterday's press release. Which brings me to today's press release, or I should say yesterday's press release. So we announced a new discovery, which was 18 meters of 2.5 gram a ton, including close to 5 meters at 7 grams a ton. And that is, at the bottom of one of the pits, right? So Filibert, the way to look at it is you have Red Fox, the pit at Red Fox, which is our main part of the resource, then Arctic Fox, Fennec Fox, and Gray Fox. So just underneath Arctic Fox at depth, we had a very nice hit, which really opens the door for underground potential there at Filibert. So it's higher grade, obviously. So this has the potential to increase the grade of the resource, which would help, the thesis of optimizing the camp. But also it opens the door for an underground resource as well, because all of the resource that we published so far is all open pit. But before we got involved, the Filibert deposit was looked at only as an underground resource. There was even an economic study based on it, based only on the underground. So there's clearly some potential on the underground. And this gets really interesting, right? Because if you look at Detour, for example, so Detour in Canada, one of the biggest miners, they are now entering the underground portion of the deposit, and they go after higher grade doing this, and that is achieving spectacular profitability. So this type of scenario where you really are getting very high grade or much higher grade at the bottom of the pit and opening the door to start an underground operation at the bottom of the pit, those are mineralizations that get the big companies excited typically. So that was one of the things that we announced yesterday. This new discovery underneath the pit of Arctic Fox. The second thing that we announced is that the mineralization underneath the two smaller ones, Gray Fox and Fennec Fox, the mineralization is still there. And not only is it still there, on very, very long length. I mean, we announced 30 meters of mineralization at 0.7, including 13 meters at 1.5. So it really looks like we can link or connect those two pits there, Fennec Fox and Gray Fox. So this whole thing seems to continue to add. And that is just yesterday's press release, because if you look at the previous press releases, we had a lot of success extending to the southeast. So we had a big hit, 200 meters southeast of the pit, 2.6 gram over 26 meter. Then we had the big hit at 750 meters, 800 meters from the pit. Also, just at the bottom of just south at the bottom of the pit, we have a lot of good results there as well. So it really looks like this mineralization keeps going to the southeast. So it really looks like we should be able to increase the size of Filibert meaningfully, and
okay,
hopefully we can even improve the grade.
Do you know what I'd like to see?
Fantastic.
I'd like to maybe see you come on with one of your technical team, maybe one of the geologists or a couple of geologists, and talk us through this, because I think the implications are quite significant. And especially when you're talking about in the context of the what IAMGold has said recently. I'm intrigued about how you play this. How much capital you allocate, how you allocate that. What you need to demonstrate, because if they aren't looking for another JV partner, but does that include you? Does that suggest that they want to take you out? Is that an option that they are considering at this point?
I mean, it is
right.
one option. It is one option. I mean, for sure, that would be clean. It doesn't mean that we are the first thing that they think about when they wake up in the morning. It's a much bigger company, and when the time's right, we'll see what the structure can be. I mean, it could be, option one, IAMGold could buy Northern Spirit. Yeah. Another larger company could come in and buy Northern Superior, and then when it's time to do a feasibility or an operational design, then joint venture with IAMGold. So IAMGold would not lose the increase in ounces that they're currently aiming to do at the assets they already have, but they would be able to share the burden of building a new mine with another major company. I mean, that's just me speculating, again, all based on what the analyst at National Bank wrote. So I don't know what the future will tell. And we have a lot of assets to go after, right? So we've been focused a lot on Filibert in the last 18, 24 months. But we also need to go after Lac Surprise, which is the western extension of Nelligan. And then we have both Crux and Chevrier, which are very decent grade and are huge systems, both of them, that can provide an enormous amount of blue sky. So, the job right now is to keep building ounces for that camp. And then we'll see what the end game is. But we have a lot of low-hanging fruit to add as far as ounces.
Let's treat this as part one of a two-part series where we will get into the weeds and get a little bit more technical, because I'm interested in the kind of the application of strategic thinking and, more importantly, strategic capital to, as you say, if you kind of change the cutoff grade, you move from 1.1 grams to 1.3 grams. That's you're 40%. You talk about this kind of 40% more gold if you do that. So it's interesting the way you set yourselves up for a situation where, lots of companies come on and pretend they're going to build this thing out, and as they should. But the reality is, when you've got a setup like this with IAMGold or someone else coming in and taking you out to be part of this kind of Shibugamu district, it's kind of clear that you need to be tactical with your allocation of capital, and I'm intrigued in that.
Yeah, exactly. And listen, not to say that our projects are not standalone.
I get it.
Right? I mean, I absolutely. Like, if you look at Filibert, I think with our next resource update, I think this becomes a standalone project. But I think that would be short-sighted to look at it that way, because so much value can be created with optimization, right? So not that we don't have standalone projects, we absolutely do. But to me, it's pretty obvious that optimization at the end of the day can create a lot of value. So it'll be an interesting time with gold going up, that camp becoming front and center, a lot of capital going to this camp. It'll be a fun time.
Brilliant. Simon, appreciate your time today, and let's make plans. We'll get you back real soon, okay?
Anytime.